You've watched the stock market power higher from the sidelines, and now you're finally ready to begin investing for yourself. But how do you start? What's the best way for a beginner to invest in the stock market? For the answers, let's turn to the legendary investor, Warren Buffett. If you haven't heard of Warren Buffett, he's the GOAT, the single greatest investor of all time. He's also an absolute master at breaking down complex financial topics and turning them into easy to understand ideas. That's also my goal for Opportunity Stocks, so if you haven't already, go ahead and subscribe to the channel. And be sure to stick around until the end of this video for a step-by-step beginner's guide to opening your own brokerage account with WeBull, and most importantly, which stocks to buy in order to follow Warren Buffett's simple, time-tested advice. In one of his most famous interviews, Warren Buffett called investing a simple game that Wall Street financial advisors have convinced the everyday investor is harder than it really is. But it's Warren Buffett, so he doesn't stop there. He goes on to say that monkeys throwing darts to pick American companies could provide better investment returns than Wall Street's financial advisors. Ouch. You can really tell he doesn't care much for the Wall Street types. But back on Main Street, Warren Buffett has been an advocate for the everyday investor for as long as I can remember. He consistently reminds us that most investors are better off putting their money in low-cost index funds. His favorite is Standard & Poor's 500 Index, commonly referred to as the S&P 500, which is comprised of the 500 largest publicly traded companies in the US. The S&P 500 is undoubtedly the most widely used index in the US to benchmark stock market returns. Over the past 100 years, the S&P 500 has returned on average about 10% per year, although some years are up and others down. Using the rule of 70, which calculates the years it takes for an investment to double in value, we can expect our money to double every 7 years in the stock market. They didn't teach me this useful math when I was in high school, that's for sure. Warren Buffett believes so strongly in the power of the S&P 500 index to generate better investment returns than any active money manager that he directed his own trustees for his wife's future inheritance to invest 90% of that money into an S&P 500 index fund. Now that's putting your money where your mouth is. For the rest of us though, it's not just one and done, unless you just received an inheritance yourself or have a huge chunk of cash laying around. We have to invest consistently over time to build great wealth. Again, Warren Buffett gives us another simple but powerful investment tip when he tells us to consistently buy an S&P 500 low-cost index fund and then keep buying it through thick and thin, especially through thin. Consistency is key. I like to say pay yourself first. When you receive your paycheck, take the first $50 or $100 or as much as you can reasonably afford, and then set up an auto transfer from your bank account to your brokerage account so that you can buy more S&P 500 index fund shares. In this quote, I also want to point out that Buffett says to buy, not sell when the market is down. One of the biggest mistakes to avoid as a beginner investor is to get spooked when the market tanks and sell everything. Wall Street loves this, so they can then buy those same stocks of great American companies at lower prices. To be a successful investor, you cannot make stock trades based on fear or greed or any emotions. You have to keep those in check and stick to your investment strategy. This is another reason why passive or index investing is so powerful compared to active investing. Over time, the market rebounds and trades higher, right? Every single time. So putting your investment strategy on autopilot is going to help you avoid selling when things aren't looking too good. It's actually best if you don't even look at the stock market daily, weekly, or monthly. There will be swings, and it's best to just ignore those as a passive investor. Go enjoy your life knowing that your money is growing over time, even in your sleep. Easier said than done, I know. This is your retirement money, your GFY money when you're ready to quit your job after achieving financial independence. And it's exciting to keep up with your investments in the stock market. So remember this, if you have to react to stock market news, then be ready to buy the dips. When I see the stock market pull back 5%, 10%, I try to find ways to save even more money to invest more money. These rare opportunities come along more often than you think, even in up years. 5% pullbacks occur about every 7 months on average, and 10% pullbacks, also called a correction, occur about every 2 years. Historically, these are great buying opportunities. Unfortunately, many beginner investors end up selling at these market bottoms and then buying again after the market recovers. So again, it's best to put your investment strategy of passive index investing on autopilot and try not to time the market. It's a fool's game. To recap, there are two types of investing, active and passive. With active investing, you are buying and selling individual stocks for the most part. It's more risky to be an active investor as you can hit a home run with the next Tesla or lose your entire investment with the next Enron. With passive index investing, on the other hand, you don't have to worry about single stock risk because you are diversified in an index. You own shares in hundreds of companies across a broad range of industries. This brings us to the next question, perhaps the million-dollar question. How do you invest in an S&P 500 index fund, and which index fund should you buy? I'm going to show you right now. This is where you have a number of options, but again, we're going to keep it simple. First, you have to sign up for a brokerage account to buy and sell stocks. There are two well-known brokerages that are popular with beginning investors, Robinhood and WeBull. Both also offer free stocks to get started. I already have an account with Robinhood, so let's sign up for WeBull together to get free stocks worth up to $1,400. I will literally sign up for anything to get free money. Of course, I'm not really expecting to get stocks worth $1,400, but maybe $12, which is on the lower end of the range per their website. But hey, you never know. Let's press our luck. I'll also add links to both of these brokerages in the description below so you can get your own free stocks too. What I like about both Robinhood and WeBull is that they're free and easy to sign up. They have no minimums to invest like the big guys, and it's free to buy and sell stocks, including index funds. All right, after you click on the link in the description, you land on WeBull's homepage. I'm going to fill out my personal details. Next, we want to add our bank details so we can easily transfer money between WeBull and our bank account in both directions. You can also schedule a monthly transfer if you want to commit to maybe $50 or $100 a month, like we talked about earlier. I'm going to initiate a single transfer this time for $1,000 so we can buy our first stock, actually an ETF. Let's take a quick step back to discuss the difference between ETFs, mutual funds, and index funds. You'll often hear these terms used interchangeably, but they mean different things, so we need to clarify each. ETFs, or exchange-traded funds, can be traded throughout the day in your brokerage account. That means the price of the ETF moves in real time, just like an individual stock like Apple or Microsoft. Mutual funds, on the other hand, only price and trade once per day when the stock market closes. I personally wouldn't invest in a mutual fund unless it was my only option in a work 401k, for example. ETFs are generally more tax efficient than mutual funds as well. So I'd recommend only using mutual funds for your retirement accounts where the growth isn't taxed within the account. So how does an index fund fit in here? An index fund is a type of ETF or mutual fund. Index funds are a portfolio of individual stocks built to track a financial market index like the Dow 30 or the S&P 500. Personally, I'm a big fan of Vanguard's index funds. Their funds have some of the lowest fees in the industry, and they have a stellar reputation. In fact, their recently passed founder, Jack Bogle, is credited with popularizing the index fund. Fees matter too, as they reduce your returns. Thankfully, they've been coming down over time. It used to be said that anything over a 1% fee was too high, and today I would even argue that perhaps 0.5% is too high. But those are the fees that are charged by active money managers. We're passive investors, so we're looking at 0.03% for VU ETF. That's just $3 for every $10,000 invested. Stocks or ETFs are often discussed by their stock ticker, and VOO, V-O-O, is Vanguard's S&P 500 ETF. Now that we know what we're buying, let's go ahead and make a trade. Let's buy just one share of VOO. We search for the ticker, V-O-O, and then we click on buy. We also have an option to change the order type, which I highly recommend. The default is a market order, which means your stock purchase will go through to the market with a request to buy your stock at the best available price. I like to change this default to a limit order. With a limit order, you control the price at which you buy or sell a stock. So when it hits a certain price, for example, that you predetermine, that's when the trade will execute. It's rare, but in times of high volume or even low volume, prices can be quite volatile, and even a flash crash has been known to occur. So to protect yourself, I always use limit orders. For this trade, I'm going to just set my limit at the current market price. And then we're going to press buy. Let's refresh that screen, and then we can see that our trade has executed, and now you own 1 share of VU. Awesome. So now you're a shareholder in 500 of America's largest publicly traded companies. Before I wrap up, maybe you're thinking, how risky is this investment? What if WeBull or Robinhood go bankrupt? What happens to my money? These are all great questions to be asking. In terms of risk, all investments have risk. You could very well lose your principal. Think Enron, WorldCom, and many others. This is why we invest in index funds. The risk is spread over hundreds of companies in the case of VU. Also, stocks don't always go up, and they certainly don't go up in a straight line. Just last year, in 2022, for example, VU was down nearly 20%. But it's come roaring back so far in 2023, and we're just off all-time highs. I also want to point out that past returns are no guarantee for the future, but it's a bet I'm willing to take. 100 years of data tells us that we can expect annual returns of around 10% on average by investing in an S&P 500 index like VU. Now, as far as what happens if WeBull or Robinhood go bankrupt, your money will be safe. Both brokerages are registered with the Securities and Exchange Commission, the SEC, and they're both members of the Financial Industry Regulatory Authority, or FINRA, and the Securities Investor Protection Corporation, SIPC. The SIPC is particularly important as it protects you against the loss of cash and securities, such as stocks and ETFs, held at financially troubled SIPC member brokerage firms. The limit of SIPC protections, though, is $500,000, which includes a $250,000 limit for cash. So unless you're investing big money here, you're covered with either of these companies if they go under. Another thing to keep in mind is that SIPC coverage doesn't protect against the loss in the market value of securities. So if you make a bad investment, that's on you. That's your responsibility. As with all investments, I recommend you consult with your own professional advisors. I'm not a licensed financial advisor, so everything I've said in this video is just my opinion and for your entertainment only. If you have any questions, though, about anything I've said, go ahead and drop those down in the comments. I'll be sure to answer all of them. All right, with that legal disclaimer out of the way, let's talk about next steps. I did my very best in this introductory video to stock market investing to give you as much actionable information as possible. But of course, there's so much more to learn. My goal with Opportunity Stocks is to help you get started investing in the market and learn the tools to achieve FIRE, which stands for Financial Independence, Retire Early. In addition to my videos, I highly recommend reading Unshakeable by Tony Robbins. After 20 years of investing experience and having read dozens of personal finance and investing books, it's my all-time favorite. I've even bought multiple copies of this book for my friends and family. It's fast-paced, easy to understand, and provides a step-by-step guide to achieving financial freedom. It literally covers all aspects of your financial life. Also, 100% of the profits are donated to Feeding America, so you'll be helping to give back as well as helping yourself. A true win-win. Definitely check it out. I'll drop a link down below. Also, don't forget to grab your free stocks over at WeBull and Robinhood. I have accounts of both now, and I'll never turn down free money. In closing, I'm going to leave you today with one final investing tip, and that's the sooner you get started, even if it's just $50 or $100 a month invested in an S&P 500 index fund, you're going to be exponentially better off down the road. Well, that's it. That's a wrap for this video. Thanks for watching. Go ahead and smash those like and subscribe buttons, and I can't wait to see you on the next video.